Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. This is the new weekly live stream that I do where we talk about private equity and and by extension, all things high-level business. This is episode 12. The title of this episode is called Negotiation. We are in the process of covering the 7 steps of private equity. And we are on on step 4, actually, today. So just to recap, the 7 stages of private equity were target identification, due diligence, valuation, which we did last week, negotiation, which we're doing today, acquisition, post-acquisition improvements, and then finally exit, right? So that's kind of the progression of these things. So we're going to continue with that today. And also, I'm going to finally answer the question that somebody left in the comments about a month ago, talking about when you get to valuation. Answer this question for me. And we did valuation last week, and I didn't answer the question. So finally, I'm going to do it here. So here is the question. It is from Dimitri. Dimitri says, I'm always looking forward. Blah, 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 blah. He doesn't say it like that. He actually says it properly. He says, I'm looking forward to the new episode of the series. Could you pay special attention to valuing high-risk assets like biotech stock when you get to the valuation episode? So, yes, I will do that. Okay, now here's the deal. For any kind of high risk type thing that you're trying to place a value on, there's going to be a lot of risk. Hopefully everybody knows the term risk means a variance that you can quantify, and uncertainty means a variance that you can't quantify, right? So for example, for a lot of things, if you're talking about like placing a value on a financial asset of some kind, like stocks in this case, you would have a past history, right, to a degree of the stock, usually, unless it's their first day being traded or something. You would have a past history. So you would analyze the past history. You'd look at the average, and then you'd look at the volatility, right? Like what's the swing, the range that of values that it has been. Right? And then you do all kinds of statistical analysis on that kind of stuff. Basically, it comes down to 2 values. One is the expected value, which is essentially the average. And the other value is the variance or standard deviation, like one of those measures of volatility. Does it always stay kind of right around the average, or is it swinging wildly, right? So that determines the risk, right? Which is quantifiable deviation, right? So if it's something like high risk assets, then presumably either there is no history of these particular assets, or there is a history, but the value's been swinging wildly all over the place, so it's very risky, right? So those are the 2 things you look at. So you look at it like any other thing that's swinging wildly like that. It's all about statistics when you do valuations, right? Sometimes you take other things into account, like the potential of the company and stuff, but that's all kind of pie in the sky, hocus pocus stuff. It's based on opinions and perspectives that you can't really quantify, right? So the finance types don't usually deal with that too much. They deal with numbers, right? So they look more at the past history. They analyze it with statistical tools, and then they place a value on it based on its average value and its swing, its volatility. Okay, so that's how they do it in theory. Now, I'm not an expert on biotech, so I'm not going to comment on anything else there. But that's the principle behind how you do these things, right? And there you go. Now, I have some notes here. It says, for next week, heavy uncertainty, reliance on milestone-based payments and earnouts. Okay, I'm not sure what that is. Anyway, so there you go. So hopefully that's an answer to Dimitri there. Let's get on with the topic of this episode, which is, like I said, is part 4 about negotiation. So this is the world of private equity. This is the buying and selling of companies. And in order to sell a company to a buyer, you have those 7 steps, right? So where we are in the process is that the private equity firm has identified a target company that they want to buy, right? They've done their due diligence on it. So they've investigated the company in several ways, like financially, legally, operationally, from a marketing perspective, all that kind of stuff from an HR perspective. And that has led to a valuation. That's where they've placed a general value on this company. This is what we think it's worth. And then now we get to the negotiation stage where they have to sit down with the sellers of the company, which are the original owners, okay, and negotiate and come to some agreement on what the price is going to be, right? And unlike a lot of simple things in the world of consumer affairs, where you go to the store and you buy something, usually in those kinds of transactions, there's usually one dimension to it: price. That's it. It's all based on price. Well, when we get to stuff like this, there's more than one dimension to it. These deals can get quite complex because, for a start, even if you agree on a price, the timing of the payments is something that adds an extra dimension to it. Are you going to pay me now, or are you going to pay me over 20 years? That kind of affects things. Also, the form in which you're going to pay me. Are you going to give me cash? Or are you going to give me stock, like shares in the new company that you now are controlling? Or is it going to be something else, right? You have things like seller financing, where, the seller lends the money to the buyer to buy the company. So, things like this. So it gets quite complicated. And the way I've always been taught to look at these things, the way I always look at it, is the deal is a system of different variables, right? Price being one of them. And there's a lot of others. So let's get into it. Okay, so who does this transaction? When you come to negotiate, who's involved? Well, you've got 2 teams, right? One team is from the private equity firm, right? We're going to call them the PE deal team. And it's usually driven by the general partners, the people that own and run the private equity firm. They're usually personally involved in these things. And then the other team is going to be the target firm's owners, right? And they're going to assemble their own team. Sometimes it's just them. Other times they have a huge collection of, finance people, legal people, industry consultants, and other consultants that they bring in to assist them in their negotiations. Okay, so it's a negotiation between 2 teams, the PE deal team and the target's owners. Okay, and I'm looking, just so you know, I'm looking at my sort of rough notes I have here that I wrote before. So of course I have problems reading them, but that's just me. If you were organized all the time, then where would the fun be, right? Okay, so like I've said here, it's the general partners. They bring in lawyers, accountants, industry consultants. The targets team, they will have their own people on it. Like they can bring in their CFO, external financial advisors, industry consultants, chartered business valuators. Where I am in Canada, there's a certification called Chartered Business Valuator. And I'm not one myself, but I've known several accountants that have had that certification. And I guess it's some formal way of authorizing them to come in and take a look at something like a company and be able to place a value on it. It's kind of a special area of finance. They study that stuff anyway in finance, and they do that sort of thing. So I guess this just formalizes it a little bit. And the whole point of doing all this is to balance risk, right? You're going to balance risk with value and come up with an agreement on that, so you sign the deal. Now, the process for how this usually works, okay? You usually make an initial offer, right? So you have the initial deal terms, and then you get rounds of offers and counter offers. That's usually the way this works. And a sort of general rule for mid-size private equity deals, at least where I am, you'd go back and forth around 3 to 5 times, somewhere like that. That's kind of the general sort of process of how this stuff works. And I just see some comments here. Ash is here. Ash says, I guess things are different in the USA because when I started submitting my full job history, I started getting a lot of interviews. Okay, so yeah, we're not talking about job interviews. This is not about job interviews. This is about private equity. Okay, so let's talk about the deal dimensions. This is a little bit more interesting, at least for me. How do you structure these deals? I already mentioned that it's more complex than simply just saying the price. It costs this much, and then you pay cash and then that's it. Doesn't really work like that. If it did work like that, there would be a lot more fraud going on. There would be a lot more obfuscation and lying going on because, if the seller wanted to sell, they could just lie about everything, hope that doesn't get discovered. And if it doesn't get discovered, then once the deal goes through, they run away with the cash, right? So that's not an ideal situation by far. So the way these deals work is that, you want some level of trust. The buyer does not want the seller lying and obfuscating all the details so that they're pulling a fast one on the buyer and the buyer's left holding the bag, right? In order for these to work, they want to feel that the seller is operating in good faith and that once the buyer is in charge of the business, the buyer's success will matter in some way to the seller. Okay, that's what they want. They want the seller working with them to make sure that there's no surprises and that things go well. And the seller is kind of their partner in the buyer now running the business, right? The PE firm now running the business. That's what they want. That's how the incentives go. Okay, so instead of relying on people to do this out of the simple goodness of their hearts, they structure the deal so that there's incentives for this to happen. The seller should not have incentives to lie and obfuscate things. They should have incentives to fully disclose, possibly work with the seller and being the new owners, maybe even be on call for consultation for certainly an initial period, right? Okay, that's what would facilitate these deals. And it would work better for everyone because then the buyer is more amenable to actually buying the business. Okay, so let's talk about some deal dimensions. First of all, there's the purchase price, right? We talked about that, okay? But there's a couple of caveats here. The payment method, right, of the purchase price. There's a couple of things you can do here. First of all, you could pay cash. You can also pay in shares. So if I'm buying your business, I'm going to give you stock in the business that I now am controlling, right? Okay. Which would give you an incentive to care about how this business is doing under my charge, right? There's things like seller financing, right? I mentioned that earlier. Seller financing is when the seller lends part of the cash to the buyer, right? So, you can pay me over time, right? With interest. You can pay that back to me. What did I write here? I mean, I already know what this is, but what did I say? When the seller lends part of the purchase price to the buyer who repays it over time with interest. This is good for the buyer's cash burden, so they don't have to pay out a huge chunk of cash all on day one. But it also makes the seller care about the buyer's success. Okay, this is usually limited to about 10 to 30% of the purchase price. You don't really see it going higher, or else it works too much in the opposite direction. It means the buyer doesn't have enough skin in the game, right? If I buy your business, but you lend me the entire amount, I could just walk away because I haven't contributed anything to it, right? And then just renege on all my commitments to make these payments to you with interest. So you're left with your own company again, and your buyer just walked away. So usually about 30% is where this maxes out, where it makes sense for everybody. The other big thing that they do in terms of the payment terms or the payment method is they do earnouts. And we talked about earnouts last week. This is an idea where it's a conditional payment you could get in the future if the company meets certain targets. Okay, so if it meets a certain performance targets, then it's written into the deal that say at the end of 6 months, if they achieve these sales targets, then we will pay you this payment as part of the purchase price. Okay, if it doesn't meet those performance targets, you don't get that money as part of the purchase price, right? And the buyer obviously likes that because it puts guarantees in place that they're not buying a lemon. If they're buying a lemon, then they're not going to pay any more for it. So that's why they like earnouts. Okay, so that's all to do with the purchase price and the payment method. That's all to deal with money. There's other things too, like for example, warranties, right? The warranty promises the seller, makes promises about company conditions, like, everything that the seller disclosed, like the financials, the legal status, the assets. If the seller lied or misled the buyer about any of these things, then the warranty in the deal will be able to handle that, okay? The buyer can seek compensation or adjust the deal if it turns out that this asset that you said was part of the company turns out not to be part of the company. We don't actually own that. It turns out you didn't actually own it before you sold it to me, so it's not mine, or anything like that. You lied about the financials, or you lied about the amount of inventory we have in stock, right? So you put warranties in the deal to sort of protect everybody, especially the buyer. Okay, another thing that you have is indemnities, right? They protect the buyer by requiring the seller to cover losses. Okay, so for example, if the buyer buys the company and then immediately gets sued by a disgruntled employee or something, and the employee wins, right? Then the seller has to cover all those legal costs and the penalties, something like that, right? So they're not held accountable for things like that. So indemnities protect the buyer. There's other aspects too. There's one more big one that I want to go into, and that's financial terms. So the other sort of deal dimension is, we talked about the payment methods and we talked about the purchase price, but the financial terms, there's like how you kind of transfer the capital around. So, for example, things like making escrow arrangements. Hopefully. Well, I don't know if people understand escrow. I'll just explain it. Escrow, it protects both parties. It's where instead of the buyer paying the seller a big chunk of cash, right, the buyer places that in the care of a third party, right? So there's a third party that holds on to the money, and the third party will release that money to the seller if they see that all the conditions have been met, right? So it's like, it's not my opinion as the seller. It's not your opinion as the buyer. It's a third party that's supposedly neutral and objective, and they can look at the situation and determine if all the conditions have been met fairly. Okay. They do this to manage risk and to align incentives, so everybody, trusts each other. Escrow protects both parties. It doesn't always just protect the buyer. Okay, so for example, warranties and performance goals and all this kind of stuff, once those have all checked out, then the third party will release the money. And you can set time frames and conditions and all this kind of stuff. So you've got a lot of different things like variables to play with there. Okay, so those are the major deal dimensions, that we're dealing with for what we're talking about here, which is sort of mid-level, small to mid-level private equity deals. At least in Canada, the ones I'm dealt with, and I believe like the vast majority of stuff works the same in the US. Let's get to the last sort of part of this, which is the most interesting part to me. When you negotiate, what are the tactics? What are some tactics that are commonly used to gain advantage during this process, right? That's what I find a bit more interesting. For example, you have either party threatening to walk away, right? That's kind of a very common thing. You also have silence. You send in a proposal and you get silence, right? And people are sometimes using that strategically to make it unpleasant and draw the process out. And that does cause a certain amount of pain, right? When people do deals, they want them to be done very, very quickly. They don't want them to drag out for years, So both sides have the option of trying to do that, and that does cause the other side some pain. So it can cause them pain too as a tactic, but they have the option. You can do the opposite. You can create urgency by setting deadlines. You can say, here's my deal, it's valid for the next 48 hours, People sometimes do kind of cheap tactics like this, and if they're known for following through with what they say they're going to do, then it does carry some weight. Obviously, the way this stuff really works, the ace in the hole, is having competitive offers, right? So it doesn't really matter if this person doesn't play ball with you. At the end of the day, you've got a fallback option, right? So if you're in discussions with a couple of different sellers for a couple of different targets, that can give you more options and therefore more bargaining power. Okay, like I said earlier, the deal is a system. You don't just have one variable, price. You got a lot of things to play with here. Some of the things you can do as an alternative to price is you could trade price for better terms. For example, longer earnout periods, okay, fewer warranties, or better payment timing. Okay, so things like this, you can sort of get those in lieu of asking for more money. Other things you can do is you can bundle issues to trade concessions. So like the thing about earnouts and things like this and payments is that you're not just protecting yourself against one issue, like for example, being sued or, losing customers when you take over the business. You're protecting yourself against multiple issues, right? If you delay your payments for the business, things like this. So the buyer might accept a higher price. They might agree to pay more in exchange for the seller limiting warranty claims or providing a longer escrow period, right? So these are things that are worth something to them, right? The trade price is the trade price. Sorry, this trades the price for stronger protections that are all bundled together. Okay, that's the idea. And some of this stuff, it's very similar if people buy houses and things, you do get this coming down, these ideas coming downscale. Other things, one last thing I wanted to mention here, there's options to bridge gaps and align incentives. For example, giving stock options. Okay, we talked about paying in terms of cash or paying in terms of shares, but you can go a step further and you can give stock options. Okay, in the combined company. So the idea of a stock option, just a very brief crash course, is that you have the share and you're not actually giving anyone any shares. What you're giving them is the right to buy shares for cheap if they end up being worth a certain amount, right? So if the share price goes up, if it reaches a certain threshold, then you have the right to buy those shares for cheap. You get a deal on them, right? So what this does is it makes people want the share price to go up. So if the seller wants the share price to go up, that means they want the new owners to be successful, right? The new owners take charge, and the sellers have an incentive in the new company under the new owners doing really well. Because if it does do well, then the sellers get like a really good deal on buying shares of that company. Like imagine if there was shares that were, they cost $10 each, but you had a deal where you could get them for $1, right? So you buy the share that's worth $10, you pay $1 for it, it becomes yours. You turn around, you sell it, and you make $9 off it, right? So that kind of thing. You can introduce options into this, and that has the effect of aligning incentives, making everyone want to be successful together, which is a good thing, right? There's all kinds of stuff you can do with like the finances and this sort of thing, but there you go. That's where I'm going to leave this today. I think in the future, what I'd like to do is get into some sort of higher level deal dimensions where you're, thinking of not just like purchasing, but you're doing mergers, and there's other things you can do that give you the same result, but it changes the deal quite a bit. So we can talk about that in future. There you go. There's 7 people here. Thank you for joining me today. If you are wanting to learn business with me, I highly recommend you check out that course, Best Bang for the Buck Anywhere. You learn everything you would learn in a Master's of Business Administration program for $100. And the catch is that it's self-study. So you get a reading list, you get the books, and then they're the same books that you use in places like Harvard Business School in their MBA program. You're getting the same source material. You read it yourself to the degree that you're interested in it. And, if you're looking just to skim the material, you can certainly do that. If you're looking to go in depth, you get that. You can get that too. But you do it entirely on your own schedule and to the degree that you're interested. So check that out if you are interested in learning business. But hopefully that makes sense. We covered negotiation, just the sort of basics of negotiation and private equity. And I answered that question from Dimitri that he asked like about a month ago. I finally got around to that today. So I can cross that off my list. So there you go. Hopefully this was interesting for you. I am going to be back actually this afternoon in about half an hour with a regular live stream where we talk about job search and all that kind of stuff. So stick around for that. In the meantime, as always, I forgot, a special shout out goes out to my YouTube channel members right there. Membership has the privileges. And my super thanks donors. You guys are awesome. I'm using the goal feature of YouTube. YouTube does for live streams, it has this goal feature. I've always ignored it. I've been doing live streaming for several years. I've ignored it up until earlier this week, where I started using it. They keep nagging me to use it, so I just used it. But my super thanks donors are awesome. I've gotten a few of those. And if you do send a super chat or a super sticker, I make sure the least I can do is I answer your question fully and completely, and I don't cave to time pressures. And special thanks to my Patreons and also to my viewers. You guys are awesome. I will be back next week, same time, with another episode of Private Equity Rundown, where we're going to cover the next step in the process, which is acquisition. This is where the change of ownership takes place. Okay, after all this talk, they finally pull the trigger on it, and we're going to talk about that next episode. So come back and tune into that. Until then, I will see you next week for private equity and higher level business stuff, and I will see you in about half an hour for job search and employment and career issues. So take care.